The capitalization rate, or cap rate, for the national portion of the real estate exam is a fundamental concept for income-producing properties and is a calculation you will face on the test. This concept is the backbone of the income approach to appraisal and is used specifically for properties that generate revenue, like apartment complexes or shopping centers. The exam will test your ability to manipulate the IRV formula, where I stands for net operating income, R stands for capitalization rate, and V stands for value. To visualize this for the exam, imagine a T-bar or a circle where income is always on top and the rate and value are on the bottom. This visual tool is your best friend because it tells you exactly which math operation to perform. If you need to find the value, you divide the income by the rate. If you need to find the rate, you divide the income by the value. If you are looking for the income, you multiply the rate by the value. The most common trap the examiners set involves the calculation of net operating income. They will often provide you with a list of numbers, including potential gross income, vacancy rates, property taxes, and mortgage interest. You must remember that net operating income is a very specific figure. You start with the potential gross income and subtract the vacancy and credit losses to find the effective gross income. From there, you subtract only the operating expenses. The biggest trick is the inclusion of mortgage payments or debt service. In the world of cap rates, we treat the property as if it were bought with cash, so debt service is never subtracted to reach NOI. If you subtract the mortgage payment, you will get the wrong NOI and choose the wrong answer. Property taxes, insurance, and repairs are valid operating expenses, but the money sent to the bank for the loan is a personal financing expense, not a property operating expense. Another area where students struggle is the relationship between the cap rate and the property value. It is an inverse relationship. If the net operating income remains the same, but the cap rate increases, the property value must decrease. Think of the cap rate as the rate of return an investor demands. If the risk of a neighborhood goes up, investors will demand a higher rate of return, which means they are willing to pay less for the same amount of income. On the exam, if you see a question asking what happens to value when cap rates in a market are rising, the answer is that values are falling. If you see cap rates compressing or going down, it usually means the market is heating up and values are rising. When it comes to risk, remember that a high cap rate equals high risk, and a low cap rate equals low risk. A luxury apartment building in a stabilized market might have a cap rate of 4%, whereas a run-down warehouse in a declining area might have a cap rate of 12%. The 12% rate is higher because the investor is taking on more uncertainty and therefore requires a larger slice of the pie. The exam might ask you to compare two properties. The one with the higher cap rate is always the one the market perceives as riskier or more volatile. To keep this straight during the heat of the exam, use the mnemonic, income is over everything. This reminds you that in any division problem involving this formula, the net operating income is always the number you put into your calculator first before hitting the divide button. Whether you are dividing by the price to find the rate or dividing by the rate to find the price, income is always on top. Also keep the phrase operating only in your mind when filtering expenses. If it is not an expense required to actually run the day-to-day operations of the physical property, like a mortgage or income taxes, it does not belong in your NOI calculation. Furthermore, keep in mind that the capitalization rate approach is only one of the three main methods of appraisal. While the sales comparison approach uses market data from similar sold properties and the cost approach looks at what it would take to rebuild the structure, the income approach, via the cap rate, focuses entirely on the future benefits of ownership. An investor is essentially buying a stream of income, and the cap rate is the tool we use to convert that future income into a present-day value. This conversion process is called capitalization. When you see the term capitalize in a test question, it simply means to convert a single year of income into an estimate of value. Mastering these distinctions will ensure you navigate the math and theory of capitalization rates with absolute confidence on exam day.